$430 million. That's the staggering EBITDA Garena. The digital entertainment arm of Shopee's parent company, Sea Limited, just pulled in for Q2 2026. This isn't just a number. It's a massive signal for where real profit opportunities lie, even for titans like Shopee. As we continue to see the rise of digital entertainment, it's clear that companies like Sea Limited are well positioned to capitalize on this trend. Garena's Q2 earnings have been driven by the success of its popular mobile game, Free Fire, which has seen a 20% increase in revenue year over year. This is a testament to the growing demand for immersive gaming experiences and the ability of companies like Garena to deliver them. Sea Limited, the Singapore tech giant behind Shopee, just dropped their Q2 2026 earnings, reporting a hefty $7.8 billion in revenue and $458 million in net profit. Shopee itself is an absolute beast, processing 4.2 billion orders and raking in 5.6 billion revenue this quarter alone, primarily from transaction fees and advertising. We're talking about a platform that moved $38.3 billion in goods, a nearly 30% jump year over year. CEO Forrest Li is projecting Shopee's adjusted EBITDA to hit $1 billion for the full year. But here's the kicker. Despite these massive figures, Shopee isn't Sea Limited's most profitable division. Sea Limited's gaming division, Garena, is actually their cash cow, generating $2.5 billion in revenue this quarter, primarily from mobile games like Free Fire and PUBG Mobile. The data from their Q2 report is crystal clear. While Shopee's adjusted EBITDA sat around $255 million, Garena, the team behind the wildly popular game Free Fire, crushed it with $430 million in EBITDA. What's wild about this is Garena's revenue was only $747 million, less than a seventh of Shopee's revenue, yet it delivered 68% more profit. Free Fire alone keeps over 100 million daily active users engaged, contributing to Garena's 666 million total active users, with 68.1 million paying for content. Even Moni, Sea's digital finance arm, out-earned Shopee in profit with $288 million in EBITDA from $1.4 billion in revenue, driven by consumer credit and SME loans. This isn't just about gaming, it's about high-margin digital services. Here's what nobody mentions when they talk about e-commerce giants. The real money isn't always in moving physical products. Sea Limited proves that massive scale doesn't automatically mean top-tier profitability. Their golden geese are high-margin digital products like gaming and fintech. This insight is pure alpha for any entrepreneur. Think about it. Garena made more profit on a fraction of the revenue. That's the power of digital goods and services. If you're looking for a side hustle or next business, consider leveraging your skills to create high-margin digital products. Whether it's developing a niche mobile game, offering a specialized SaaS tool, or even monetizing a high-engagement community. Start by exploring no-code game development platforms, or even micro-SaaS ideas that solve a specific problem for a small audience. That's where the leverage is. Don't forget to hit that subscribe button for more actionable insights. Wall Street analysts are buzzing. Many are recalibrating their models for major tech players across Southeast Asia. Financial strategists at firms like Fidelity are highlighting how this earnings report from Sea Limited underscores a critical pivot. Sustainable growth isn't solely about marketplace volume anymore. They're pointing to the surprising resilience and revenue generation within the interactive media segment. It suggests a broader reevaluation of how valuations are assigned to multifaceted tech conglomerates. Expect more focus on diversified revenue streams and less on raw gross merchandise value from here on out. This shift is a wake-up call for investors, pushing them to look beyond the obvious. It's a clear signal that the underlying tech infrastructure and content consumption are where the real returns are generated. What happens in Singapore doesn't stay in Singapore, especially when we're talking about a tech titan like Sea Limited. This earnings report is sending ripples across the global tech landscape, particularly in emerging markets like Latin America and India. Companies there, often replicating similar multi-vertical strategies, are now under pressure to demonstrate analogous strengths in their non-retail segments. Investors are asking tough questions. Where's your gaming arm's equivalent earning power? It's setting a new benchmark for diversified tech conglomerates worldwide. We're seeing a shift in capital allocation, with venture capitalists and private equity firms starting to prioritize platforms that have robust, premium digital content offerings alongside their core retail operations. This isn't just about one company. It's a blueprint for future tech investment. For a historical parallel, think about Amazon a decade or so ago. Everyone knew them for online books and then, well, everything. But the real game changer, the engine of their eventual trillion-dollar valuation, turned out to be AWS, Amazon Web Services. A completely different business line, behind the scenes, yet it became their cash cow. Or consider Netflix shifting from DVD rentals to streaming and then dominating content production. This situation with Sea Limited feels eerily similar. The market perception is one thing, but the internal earnings report reveals a powerful, less visible asset driving significant returns. It's a classic innovator's dilemma playing out. The public-facing brand might be one thing, but the truly lucrative, high-leverage business sits elsewhere, often in a premium service or platform layer. Businesses that master this strategic pivot capture immense long-term value. Who's truly winning from this strategic shift? Certainly, content creators and game developers building within major digital content ecosystems are seeing a surge in demand and potential revenue streams. Think indie studios on platforms like Steam or Epic Games, or even individual streamers and virtual item designers. They're the ones riding the wave of increased user spending on interactive experiences. On the flip side, pure-play online retailers that haven't diversified into complementary digital offerings are feeling the squeeze. They're stuck in a race to the bottom on price, with razor-thin margins. Also, advertising agencies focused solely on traditional product sales might find themselves scrambling to adapt as more marketing spend shifts to in-game promotions and digital events. The unexpected winners are platform providers who facilitate these rich digital interactions. The losers are those caught flat-footed, relying on outdated business models.